Welcome to the video presentation of the influence profitability on corporate value with capital structure as an intervening variable. Study on property and real estate companies listed on IDX in 2021 until 2023. The property sector in Indonesia plays a significant role in the national economy, particularly in job creation and its contribution to the gross domestic product or GDP. The property sector usually grows as the economy grows. When the economy grows, people's purchasing power tends to increase, which in turn can stimulate demand in the property sector. However, during the 2019 until 2023 period, many property companies faced pressure to maintain their financial performance due to the COVID-19 pandemic, fluctuations in interest rates, and changing economic conditions. During this period, business development in property sector experienced significant fluctuations. According to data from the Central Statistics Agency, the property sector experienced a positive growth trend in 2019, with the fourth quarter recording a growth rate of 5.8%. However, in the fourth quarter of 2020, the property sector experienced a significant decline of -5.7% due to the impact of the COVID-19 pandemic. Then, in the second quarter of 2021, it experienced an increase of 4.4% and rose again to reach 4.8% in the first quarter of 2022, although in the following quarter, it experienced another decline. External factors such as fiscal incentive policies from the government, changes in interest rates, and property market conditions also influence capital structure and corporate value. For example, the government bond VAT or DBP policy and the relaxation of loan-to-value or LTV regulations in 2021 encouraged an increase in property purchases, which in turn contributed to a rise in corporate value. However, in 2022, inflation and rising interest rates caused a decline in people's purchasing power, which ultimately impacted profitability and corporate value in property sector. The development condition of the property sector can also be seen from the corporate value through ratios price to book value or PBV. Several factors that can influence corporate value are profitability and capital structure. In this research, profitability is measured using the return on assets and return on equity indicators. The capital structure is assessed using the debt to equity ratio, whereas corporate value is evaluated using the price to book value. Thus, return on assets, return on equity, and debt to equity ratio are important indicators that reflect a company's financial health. These three indicators are often used as references by investors in assessing a company's performance and its growth potential in the future.
Through the research, we aim to examine and analyze the effect of profitability on corporate value, analyze the effect of profitability on capital structure, and analyze the effect of capital structure on corporate value. The data used in this research comes from financial reports of property and real estate companies listed on the Indonesia Stock Exchange IDX during the 2021 until 2022 period. This data was chosen because it reflects the company's actual financial conditions. And can be used to measure profitability variables ROA, ROE, capital structure or DER, and corporate value or PBV. In addition, data from annual reports is also used to compare the performance and trends of the property sector as a whole. Statistical results using the method structural equation model partial risk square or SIMPLS shows that first, profitability has a positive and insignificant influence on corporate value. These results are supportive signaling theory, which state the high profitability can provide a positive signal to investors, thereby increasing corporate value. However, in the long-term oriented property and real estate industry, investors tend to consider other factors such as asset growth and future project prospects, so current profitability may not immediately have a significant impact on corporate value. Current profitability has a negative and significant influence on capital structure. The higher it is profitability the company, the lower the use of debt in its capital structure. These results are supportive taking other theory, which states that companies with high profitability prefer internal funding or retained earnings over debt. However, in the property and real estate industry, companies often require large funding for long-term projects, so that even though profitability is high, some companies still use debt to maintain liquidity and project continuity. Third, capital structure has a negative and significant effect on corporate value. These results are supportive backing of the theory, which suggests the increasing debt can have a negative impact if the company exceeds optimal leverage, or if the market interprets increasing debt as a bad financial signal. However, in the context of the property industry, because companies often use leverage to fund large projects that have high value in the long term, the use of debt doesn't always have a negative impact. Fourth, capital structure has a role as a positive and significant mediating variable in the relationship between profitability and corporate value. This means that higher profitability can increase corporate value through optimal capital structure management.
The study suggests that profitability influences corporate value both directly and indirectly through capital structure as an intervening variable. Companies with high levels of profitability demonstrate the ability to generate earnings from their operational activities, thereby enhancing their attractiveness to investors and contributing to increase in corporate value. However, profitability also affects management decisions in determining the optimal capital structure. Highly profitable companies tend to rely on internal funding sources rather than external debt to finance their operations. As a result, maintaining a balanced capital structure with controlled debt levels can minimize financial risks, thereby increasing investor confidence and enhancing corporate value. In this regard, companies need to manage profitability optimally in order to finance business operations more efficiently, reduce reliance on high-risk debt, and balance the capital structure to enhance corporate value. Thus, this concludes the presentation of our research finding. The research team would like to express our sincere gratitude to Bina Nusantara University for their support in the completion of the study.